Bill, do I have it right that you were short Treasuries heading into the sell-off we've seen over the past 5 to 6 weeks?
You do have it right. I'm not always right, but I anticipated the possibility, at least, of the 10-year selling off, and it has by 30 to 35 basis points. I mean, at this point, the CRB is up 40% over the past 6 to 9 months. Inflation itself, in terms of the dollar's down 10%. Fiscal stimulation at 2 trillion plus. We had an import price index number this morning that really is 8% annualized, and household income is going gangbusters. And so there's no reason to expect that inflation, at least, not necessarily Treasuries, but inflation at least will be screaming higher over the next several months. And that's what some investors are anticipating.
Well, they certainly are, and they'll be more interested in the term you just used, screaming higher. Commodity price inflation through the PPI feeding into what? Screaming higher means exactly what?
Well, a 40% rise in commodities doesn't necessarily translate into a 3 or a 4 or 5% increase in terms of the CPI, but a decline of 10% in the dollar and the import index, which is related, it was highly influential. And you have to know, or we all know, that fiscal stimulation has been substantial in the past. A lot of it has been saved. Some of it may be spent, and we've got $2 trillion or more to come, as well as an infrastructure bill that most investors are assuming will pass. And so, there's significant demand that is stored up, power that is stored up, that it can be unleashed if consumers want to go in that direction. And I think to a certain extent they will. To 100%, that is the broad question. That's what Chairman Powell tomorrow, I assume, will talk about. How much will be saved, how much will be spent. But in any case, inflation, currently below 2% now, is not going to be below 2% in the next few months. I see a 3 to 4% number ahead of us.
Bill, there is no recent history in Fed policy, certainly not since Paul Volcker, of letting inflation run hot for the sake of jobs and for the sake of growth. Do you think Jay Powell will have the stomach for it once he sees prices rising meaningfully faster than 2% a year?
Well, that's a great question. Of course, he said in the past that there's a lot to make up, that because inflation has been below 2%, and in some cases below 0, that he can live with 2% plus inflation for a relative period of time. That's the question that you've asked me, and that's the question that the markets are asking. How long will that be? Will it be 3, 6, 12 months? Right now, the short end of the market, the Eurodollar market, is anticipating a March 2022 first increase. And that's something that Jay Powell, I think, would deny. Certainly the dots on the dot plan by the Fed would belie that as well. But I think 3 to 6 to 12 months at 3 to 4% plus inflation will give him pause in terms of his current policy.
Of course, the talk in the bond market is that the Fed policymakers will be forced to tighten sooner than they're planning. And of course, if that in fact does happen, there's the potential for a taper tantrum. How real is that potential?
Well, I think it is. I mean, the deficit is, $3 to $4 trillion. The Fed is financing perhaps half of that, and other central banks are financing perhaps half of that. And so it's up to the rest of us, the vigilantes or the hedge funds or whoever, to fill the gap. I have a hunch that what was known as Operation Twist in the late 40s after World War II, and the Fed trying to keep interest rates down by buying 10s and longer bonds, that Operation Twist may be in our future, where the Fed is limited to, perhaps a trillion or so in terms of outright spending, but they begin to spend more on 10s and 20s and 30s in order to keep those long-term interest rates down. The 10-year is influential on mortgage rates. Mortgage rates are influential on housing. And so I think we have Operation Twist in our future. We might even have had Operation Twist in the last 2 weeks. I don't know that, but it smells a little bit. It smells a little bit, Eric, because we got up to 165 or 70. There was a panic type of mode, and all of a sudden we're back down to 160. But that's just conjecture on my part.
Are you still short Treasuries, and if so, where on the curve?
Yeah, I'm short the 10-year future, which is a 7-year, 6-year piece of paper. I'm short the long bond to a certain extent. There's an interesting thought, and I'm sure you've maybe even interviewed Scott Menard from Oppenheimer or not.
Guggenheim.
Yes, Guggenheim, sorry. He basically isn't necessarily a bear or a bull, but he suggests that it remains to be proven whether a bear market is in our future, because the 10-year and the 30-year are in these long-term downtrend channels that started in 87 and 86. And the 30-year bond at 250 basically is at the top of that range, and the 10-year at about 2 is at the top of that range. And so he basically says that until proven otherwise, until breaking those channels, we're still in this downtrend. I disagree with that, but it's an interesting proposition.
While I still have time, I want to ask you about this. I also heard that you made a tidy sum trading GameStop in the January short squeeze. Tell me about that.
Sure. Well, I got in too early. I got in with options like a good Robinhood trader, I guess, and selling options, not buying options, selling calls. At around the $150, $200 level, it went to 400. There's an adage by Bernard Baruch way back when that said, "Sell to the sleeping point." Well, I wasn't selling to the sleeping point, but I did manage to overcome my insecurities and hold on and ride it all the way back down in terms of getting out. I'm back in. I'm still selling call options at 250 and 300. The volatility is super high, Eric, and that promotes an ability to make some money if
So you were effectively still short GameStop.
Yeah, not a lot. I mean,
through the options market, it's not like you've got a short position, a borrow and a short position on in the cash market, but.
Well, it sort of is if the option comes due, if the expiration comes due, and you are forced to short shares. But, right now the borrowing rate on shorted shares for GameStop is only 1.5%, which indicates no real squeeze or no real pressure. And so with volatility at 400% annualized, it's really, you need a doubling and a doubling in order to start to lose money. And I think this is a perfect opportunity for option sellers, not buyers, to take advantage.
How much have you made on those trades so far?
Well, I was in the hole by about 10 million, but I'm about the same amount above ground.
Now, very quickly, what else are you active in right now? What are your deepest conviction long and shorts?
Well, about 6 to 12 months ago, I got into natural gas pipeline stocks. They were very cheap. Buffett was getting into them at the same time. They were yielding 13 and 14% tax deferred because they're partnerships. And, I caught the ride on energy. I didn't really forecast the current oil price, but I thought that those yields, which are, again, partnership tax deferred, were extraordinary. And so that's my main focus, 40% of